Hi everyone, we are looking at chapter 11, and so this is a worksheet for a merchandise company. So if you remember, what we did in 1303 was looking at a service company essentially, and then the last couple chapters we've been learning about a merchandise company. So assuming that we buy products that are already made and we resell them. Now we got to go in and look at how do we do the closing entries. There's a few more adjustments in closing entries or differences in closing entries with a merchandiser versus with a service company. So remember there, I'm going to try to kind of draw over here on the side as we talk about this too. There are two types of inventory, right? So we have periodic and we have perpetual. So under perpetual, that means you continuously keep up. So as things are sold, they're adjusted. So the inventory balance reflects the true amount that is in an inventory. But in periodic, we just periodically keep up with it. So what we have on our books is the beginning balance. And then we get down here to end of, oh, that was a bad E, end of month, or maybe end of year. I'll put a /y, year. We don't have on our books what we really need to reflect, right? Because all we have is this beginning balance, because in between all of this, we've been putting it to purchases. That's what we learned in chapter 9 and 10, right? When we bought stuff, it went all in between that period. So what is this number? Well, we got to do a physical inventory count to figure out what is our ending inventory. So we have to make an adjustment when we close out the book. So essentially, we're going to have this formula. It is going to be beginning inventory plus purchases. And I say purchases, that's also going to include your freight. And that gives you available for sale. Okay? Then we're going to come in and subtract ending inventory. And what that leaves us with is what's called cost of goods sold. So I always abbreviate that COGS. So this is our formula. So when we come in and do our adjustments, what we have on our books in our inventory account, we have a debit for beginning inventory, right? And we need to figure out what is this number, right, for ending inventory. So to make that adjustment, there's two ways. Logically, you guys could say, well, we just take the difference and plug it in here as a credit, which, yes, I agree. It just makes so much more efficient use. But what your book is going to have you do is whatever your beginning balance is, you're going to come over here and do a credit for the beginning balance. I left out the E, but the beginning balance inventory, you're going to credit it and take it all off the books for the inventory account. And then you're going to come over here and do a debit for ending inventory so that your ending inventory account matches what you counted for. So let me go in and let's look at the next page. When we do this, see there's that formula again. Now I say over here purchases, but I mean purchases and freight. I just, out of habit, that's what we do in principles. We just call it all one thing. So that's what I mean when I say purchases. And they don't always show you this available for sale, but that's how I teach it in principle. So essentially the formula works out the same. Now what they're telling you over here, you see this adjustment? This is like that T account I was doing right here. There's your beginning balance. They're going to come in and have you do an adjusting entry to credit your inventory for what your beginning balance was, and you're going to put it to income summary. Remember, I think it was back chapter 4 or 5, income summary was that temporary process to close out revenue, sales, and your expenses. So now we're going to use it to close out inventory. We're adding to those adjusting entries in our closing entries. So we close out inventory to income summary, and that's what they're showing you in this area. Then we're going to put back on the books down here what the ending balance was. And when we put it back on the books, you're going to take it out of income summary for the credit amount and put it on the books on the inventory account as a debit. So what they're saying is this difference between the 9,000 or 19,000 and 4,000, that 15,000 represents the inventory that you sold over that year. And when they come in and look at this number, they're giving you this coaching tip here. They're saying beginning inventory plus whatever their purchases were gave them that available for sale. Now, see that now they're pulling in the formula I'm using, but up above they didn't. Then we subtract out what was our ending inventory, the 4,000, and we say, okay, 65,910 was our cost of goods sold. And I know I just said 15 up here, but you got to think of it. You started with 19 on your shelves, and you got 4 on your shelves. So of that, 15 is now off the shelves, plus everything else that you had bought during the year is gone too, right? So that's how you come in and calculate your cost of goods sold. When we do those adjusting entries, eventually cost of goods sold is a expense account. So part of your adjusting entries, or your closing entries, sorry, will be when you come in and if cost of goods sold has a normal debit balance, to get rid of it, we would credit it. So we would do income summary for the 65,910. I'm using their numbers, and we would credit cost of goods sold for 65,910, and that would be your closing entry on top of all the other entries we had done before. So let me clear all that, and we'll talk about the other thing in this chapter. Unearned rent. This is an interesting topic. I don't know. I try to talk about it when we have it back in chapter 4, I think, when we had adjusting entries. Unearned rent sometimes is a difficult concept. And I think it's because you see the word earned, and we associated earned with revenue. But you got to remember, what does this word have in front of it? It's got un in front of it, right? So if it's unearned, that means it's not earned rent. So someone has paid you up front for rent, or it doesn't necessarily have to be rent. It could be a magazine subscription. You pay up front for a subscription, and you get the magazines for the next, I don't know, year or 24 months or whatever their terms are. So it could be unearned revenue as well. So don't get hung up on that it's just rent. There's all types of unearned. So essentially what it is they've paid you up front for an amount, and you have not performed your duties as a business owner to be able to record it. So this is the revenue recognition principle. Okay, I'm going to abbreviate that. So it's the revenue recognition principle. You cannot record revenue until it has been realized or realizable and earned. So right now, this is all sitting over there as a liability, meaning we owe that money back to our customer in the event we don't perform our duties. Once we have done the service, or given them, had the rent, or we have provided the magazines and the subscription, then you can go in and record it as a revenue. So when we put it on the books, we put it on as a liability. You increase the liability with a credit, right? So this adjustment is when we have come in at the end of the month and we said, okay, we have let you stay in the building for 2 months. And so now we get to record, we've performed our duty. You've had that building for 2 months and we're going to record 2 months of revenue. So if this liability needs to be reduced, then we would have to go in and debit it, right? So when we do this adjusting entry, we are going to debit unearned rent or whatever the revenue account. It can be something else. And we're going to go in and categorize it as sales or revenue, whatever account we have, for the amount that we have earned for that period. So I think in your problem in the book here, they talk about rent. What is it here? Read. They paid $600. They paid $600 for 3 months of rent in advance. Okay, so how much would that be per month? Well, that would be $200 a month, right? So 600 divided by 3 gives you 200. So it sits over there in the liability account. We get down to the end of the period. What is it? Did they give you an example? Let's say we get down to the end of the period and we've earned 2 months out of the 3. So how would we make that adjusting entry? Well, if we come in and do us a T account over here for unearned rent, we put in 600, right? And if we have earned 2 out of the 3 months, then that means we would need to debit 400 to have a balance of 200, right? So this is the 2 months that we have earned. So when you did this, instead of doing these X's here, we would do 400 and 400 to show that we've earned that revenue. So that's the adjustment that they're doing for unearned rent. So like I said, hopefully that makes sense for you. And let's see what else they've got. I'm not a big fan of the worksheet. Just in real life, not a lot of them do it. But that's what this chapter is, and the book's going to have you do it. Maybe some mom and pop places do that. They have changed up their chart of accounts a little bit, right? Assets are still 1s, liabilities 2s, equities 3, revenues are 4. What they have changed, and this is just a preference by author because it's not always that way. I told you that our expenses were always going to be 5s, right? Well, they're trying to separate out cost of goods sold from regular expenses just so you guys can keep it separate. I'm still going to call all of this a 5. That's just me. To me, it's all an expense. It's all a cost account type situation. So I'm still going to refer to all of these as 5s. So don't let the numbers get thrown off. They're still treated, cost of goods sold is still treated as an expense. So worksheet, if you guys remember, you have your columns for your trial balance. It should be in chart of account orders. Now remember, when we do these adjustments, they are not always, holy cow, they give you a whole list here, don't they? They're not always in chart of account order because we add some extra stuff at the end. Oh my goodness, there we go. So our first 2 columns are trial balance, debit and credit. Then our next columns are the adjustments. So we had the previous adjustments that we did in chapter 4 with supplies and prepaid insurance and accumulated depreciation. We're adding this new inventory. That's what they're showing here in the blue, the inventory adjustment. And then the other thing that we're adding is this unearned rent. Now I know it comes in at letter C, and switch this back. Letter C, there should be, oh, that's not good. Can't write on the screen. Anyway, you got those 2 points, and then letter C is also down here. So let me clear those. There's your other letter, letter C. And G, what do they have? They have Salaries expense, that's high. That should be normal what we had for salaries expense. Salaries payable. So you can match your letters up, make sure it all matches up. There's that inventory into income summary. And they do it to income summary and an adjustment because income summary doesn't ever have a balance at the end. So we have our adjusted trial balance. We've got that going on. You just sum across the columns, trial balance and adjusted. Oh, and then they flip the page on us. Oh, joy. Then you end up taking those accounts and you put them in your income statement, right? Now, income summary essentially is going to get closed out in the closing entries. And then you have your balance sheet. So it's still working the same that we had done before. You just have those few extra new journal entries. And okay, now they give you a completed worksheet. So many pages, right? Okay, this is a little bit better because now it's not horizontal. So they've got the adjusted trial balance here with the balances. Income statement, they're closing that out. It really does not show on the income statement. It's just a way for them to be able to make sure that zeroes out and shows the 15,000 when you add up your debits and credit. So don't let that throw you off. So that is the chapter. Not a whole lot there, but those two journal entries can throw you off a little bit. All right, so I think that's everything I wanted to go over in chapter 11, and then I'll do a separate video with the homework.